Fixed versus semi-fixed versus trading. The strategic asset pyramid. The fixed versus semi-fixed versus trading framework creates a balanced asset allocation strategy that addresses preservation, growth, and opportunity. When visualized as a pyramid, each tier serves a specific purpose while contributing to overall portfolio resilience. At the foundation lies the fixed allocation, assets intentionally segregated from trading activities and designed to remain untouched except during significant systemic restructurings or generational wealth transfers. This foundation typically consists of physical precious metals stored securely outside the banking system, creating a bedrock of purchasing power preservation independent of digital systems or market access. Depending on your conviction and technical skills, you might balance this hard money base with a smaller Bitcoin allocation. The fixed allocation's primary function is insurance rather than speculation or yield generation. These assets represent your ultimate financial backstop. Designed to survive extreme scenarios like banking system failure, extended grid disruptions, or monetary system transformations. The percentage allocation should reflect your personal risk assessment regarding systemic vulnerabilities. More skeptical investors might allocate 20 to 40% of their strategic assets to this category, while those with greater confidence in institutional resilience might maintain 5 to 15%. The middle section, the semi-fixed allocation, bridges preservation and growth. These assets remain primarily focused on long-term holding rather than active trading, but offer more flexibility than the fixed allocation. The semi-fixed allocation might include strategic assets such as paper metals, stocks, and potentially cryptocurrencies. Semi-fixed assets should align with your longer-term investment thesis. While still selected for resilience during system stress, these holdings can be strategically adjusted during significant market phases. For example, during extreme gold-silver ratio readings above 100 to 1, you might shift a portion of paper gold holdings to paper silver, anticipating ratio compression. The semi-fixed allocation typically represents around 40 to 80% of the strategic asset pyramid, creating a substantial middle ground between pure preservation and active trading. This tier restrains the impulse to overtrade during volatile markets while maintaining sufficient flexibility to adapt to major structural shifts. At the pyramid's apex sits the trading allocation, your most active and dynamic tier. This tier operates with shorter timeframes and higher turnover, focusing on capturing value through strategic entries and exits across market cycles. The trading allocation might represent anywhere from 0 to 25% of the strategic asset pyramid. However, research consistently demonstrates that most retail investors who frequently trade underperform over the long term, and most would be wise to keep this allocation limited in size, if implemented at all. Successful implementation requires clear rules regarding position sizing and profit-loss distribution. Many practitioners adopt the growing pyramid concept, where trading profits are systematically distributed throughout the entire structure. For example, you might establish a rule where 1/3 of net quarterly trading profits automatically transfer to your fixed allocation, 1/3 to your semi-fixed allocation, and 1/3 remains in the trading allocation for subsequent opportunities. This distribution creates a powerful compounding effect while preventing the psychological trap of becoming increasingly aggressive after winning trades. Cash as a strategic asset. Cash deserves special consideration within this framework. When anticipating broad market declines, temporarily increasing cash allocations within your semi-fixed tier represents a legitimate strategic position, not merely an absence of strategy. Cash functions as both a defensive asset during deflationary episodes and as strategic optionality for future deployment. However, cash positions should remain carefully calibrated rather than becoming default holdings. Extended periods of high cash allocations effectively transform your strategic asset approach into market timing, potentially exposing you to significant currency debasement over time. Implementation across investor profiles. The pyramid framework's flexibility allows customization based on risk tolerance, market experience, time horizon, and liquidity needs. A risk-averse investor with significant concerns about the financial system might implement a 35-65-0 pyramid structure, 35% fixed, 65% semi-fixed, 0% trading. This allocation provides substantial protection against systemic risks while maintaining flexibility to adjust to major market shifts without active trading. In contrast, a highly active trader with confidence in the financial system might utilize a 5-70-25 structure, minimizing the insurance component while maintaining a substantial semi-fixed core and allocating a quarter of their strategic assets to active trading. A particularly interesting case might be the highly active trader with low confidence in the financial system who might implement a 40-35-25 allocation, maintaining a substantial insurance layer while still allocating significant capital to both long-term investment and active trading. Practical implementation and conclusion. Implementing a pyramid approach requires several practical considerations beyond theoretical allocation percentages. Account structure becomes important. ideally maintaining separate accounts or wallets for each pyramid tier to reinforce psychological boundaries. Clear documentation of your allocation strategy should include profit distribution rules and rebalancing methods for situations where individual allocations deviate significantly from their target percentages. Such documentation can provide crucial discipline during emotional market periods. The pyramid system creates a cohesive framework that transforms the psychological burden of market volatility into a structured approach where each asset serves its appropriate function. The fixed allocation creates genuine security regardless of market conditions. The semi-fixed allocation maintains long-term appreciation potential with controlled volatility, and the optional trading allocation allows active participation in market opportunities without risking core capital. Together, these tiers create a robust system, a truly resilient approach to navigating the convergence of traditional finance and emerging alternatives.